76.4. Personally, I use 76.4, and that's just based on experience and also a basic trading axiom that I like to be a little more conservative because we're using these things as targets and support resistance, and so I'd rather be in and out a little earlier than wait for the market to get to 78.6. Sometimes you'll miss entries and exits if you wait for the bigger number. It's just a practical consideration, but I've seen it happen so many times over the years that I've adopted it into my trading. Okay, now various traders use all kinds of numbers. There's Gartley patterns, there's astrology, there's squares, there's all types of different trading geometry that can be used. So in this webinar, we're going to keep things simple. We only have so much time. We're just going to use the following numbers and their extensions. So we're just going to use these numbers that we talked about. Now, where you place the decimal point and all of that, that's not really a major issue here. Some people will, and I've even played around with that as you've seen on my slides. The point is the ratio. So we're going to use 0 to 100 is your range that we're dealing with. And this is generally for extent or retracements, but can also be used for extensions. 50% is obviously a halfway move between a beginning and an ending point. It's generally measuring a move in the market from a high to a low or a low to a high, an impulse move. And that complete move from that low to that high would be a 100% move. And then we divide up or section up that move with these ratios that we've already discussed. So here's an example, Fibonacci retracements. And let's see what other kinds of, use a little drawing tool here. I'm going to use this arrow. This might be a little more clear. So what we've got here is, we're starting here. What we're doing is we're saying, okay, here's a high, and then the market made what we call an impulse move and went all the way down to this low. Now, we want to look at percentage retraces from the high to the low for potential support resistance levels. And so here they are, 23.6% of back toward the initial high, 38.2 back toward the initial high. There's your 50% level. There's 61.8 and 76.4. So you can't start using them until after we've reached that low. So now, one thing I want to point out here, by the way, just as a side note, look, here the market goes to 23.6. And what does it do? Does it stop there? Does that provide resistance? No, it doesn't. Market goes to 38.2. Does that provide resistance? Does the market stop there? No, it doesn't. Here it comes to 50%. Does that provide resistance? Yeah, that one does. So this is just a little foreshadowing here to raise the issue that, actually, let me put that in the way of a question. How would you know that the 23.6 level is not going to provide resistance, where the 38.2 is not going to stop the market, but the market wouldn't stop until it reached 50%? How would you know that? The answer is you wouldn't, based purely on using Fibonacci tool like this, or Fibonacci ratios, or Fibonacci levels, whatever you want to call it. You wouldn't. And so the point is Fibonacci cannot be used exclusively, cannot be isolated and used only along with price bars. It must be used in conjunction with other things. And we're going to get to that in more detail later. But it's just a good time to point that out right now. On the other hand, you can see that these levels do provide support resistance. So 50% there, and then when it comes back down, sure enough, it goes to 23.6. Then when it comes back up here, yeah, it goes through 50 this time, but it goes up to 61.8. Comes back down to 23.6. Comes back up to 61.8. Now, the other thing that I want to point out, though, is if you notice at each one of these, where I have those blue arrows, notice that price doesn't stop right on the line. Sometimes it goes through the line a little bit, And sometimes it doesn't quite reach the line, like this low over here. Didn't quite reach 38.2. So these lines should never be considered lines, okay, even though they're drawn as lines. Consider them zones, areas. And the market is messy. The market is not that neat. The market does not really operate innately with Fibonacci numbers. It's people. People are watching these levels. People are trading these levels. Massive numbers of people. And so that's the point, is that people, because there's massive numbers of people who will see these levels, some will blow through it a little bit, some will get conservative and they'll take their trades off or put them on before it reaches that level. And everybody might have their tools drawn a little bit differently or draw it off different highs or different lows. And so don't expect this stuff to be pinpoint perfect, because people are not pinpoint perfect. Okay, so those are Fibonacci retracements. Now let's talk about Fibonacci extensions. Fibonacci extensions, you use a tool that is a 3-point tool. So what we do is, instead of measuring how far the market is going to retrace back toward the original high, Fibonacci extensions are used to measure, in this case, since we're going down, support levels where we might want to take profits where it goes beyond the low. So again, our initial point is a high, and then here's a low. Well, if we were doing retracements, we would then look for levels above this low. But now what we want to do is we want to create targets below that low. In other words, we're going to wait for another retrace, and then we're going to go short, and we're going to anticipate. Our goal is for the market to make a new lower low. But then we want to have target levels in order to take profits off of those new lower lows. Well, where do we expect the market to go? Where are some target levels? That's where Fibonacci extensions come in. So it's a 3-point drawing tool. You go from the high to the low to the next high. And then this tool will draw Fibonacci levels below that high. Now the same numbers, 23.6, 38.2, 50, 61.8, 76.4, and 100%. 100% is considered what we call a measured move. And that's a very significant level. So as you can see, again, very important that as the market comes off of this high, which Fibonacci ratios hold and which don't. Well, some don't. Not every one of them holds. For example, here we blow right through 38.2, just slam right through it. And we end up going down to 76.4. Then we come back up to 38.2. Then we go down to 100%. We get our measured move. It comes all the way back up, 23.6, goes back down to 76.4. So they do provide support resistance for sure, but which ones will, which ones won't, we're going to need more information for that. Now, one thing to do to help you along that line, to create higher probabilities of knowing which levels will hold and which won't, is to look for Fibonacci clusters. And you can draw Fibonacci clusters many different ways. One way you can do it is by combining your retracements and your extensions. Okay, so this time we'll use a long example. Here's our initial low, and then here's our high. So that's your impulse move. Okay, and then off of this, we have another low, and then we have another high. So we have a big impulse, we have a small impulse move, and we have a big impulse move. So off of the big impulse move, we can draw Fibonacci retracements. So here's our retracement levels. 23.6 of this big move, 38.2, 50, and so on. Off of the smaller move, we can do our high, low, high, 3-point drawing tool. And then here you can see the Fibonacci extensions drawn. Okay, this would be our measured move, 100%, 76, 61.8, 50, and so forth. So now what we look for is we say, okay, where do we see two lines come in and cluster close together? Well, obviously we see two lines right here. The 76.4 of the extension